Let us commence this module by studying about the development of accounting theory. Accounting theory was distilled from accounting practices. As such, the process of theory construction was of the reverse order, that is, making accounting practice the basis of constructing a theoretical framework. The descriptive approach. Theories developed using the descriptive approach are essentially concerned with what accountants do. In developing such explanations, descriptive theories rely on a process of inductive reasoning which consists of making observations and of drawing generalized conclusions from those observations. In effect, the objective of making observations is to look for similarity of instances and to identify a sufficient number of such instances as will induce the required degree of assurance needed to develop a theory about all the instances which belong to the same class of phenomena. As applied to the construction of accounting theory, the descriptive approach has emphasized the practice of accounting as basis from which to develop theories. This approach has attempted to relate the practices of accountants to a generalized theory about accounting. In this view, accounting theory is to be discovered by observing the practices of accountants because accounting theory is primarily a concentrate distilled from experience. The descriptive approach results in descriptive positive theories of accounting which explain what accountants do and enable predictions to be made about behavior, for example, how a particular matter will be treated. Accounting theories deduced from accounting practice were descriptive in nature. Such theories, which are positive and predictive, merely establish relations between observations without commenting on the same. Normative theories, on the other hand, are prescriptive in the sense that they prescribe the behavior, that is, what accountants should do or the rules to be followed in preparing financial statements and communicating accounting information to the users. After starting this module, you shall be able to learn the theoretical framework of accounting on the basis of which this organized body of knowledge has been developed. Identify the problems faced by an accounting practitioner. We shall now understand the methodology for the formulation of an accounting theory. Like in other disciplines, a methodology is required for the formulation of an accounting theory. The divergences of opinions, approaches and values between accounting practice and accounting research have led to the use of two methodologies, one descriptive and other normative. Two primary methods of reasoning are applied in research, inductive and deductive. The inductive method involves reasoning from the particular to the general, while in the deductive method, the reasoning is from the general to the particular. The following examples will make the two methods of reasoning clear. Induction. If every hare which we have observed eats grass, by induction we may induce that all hares eat grass. Deduction. From the general proposition that all hares eat grass, we may by deduction infer that some hares eat grass. All formal theories that can be tested and verified include elements of both deductive and inductive reasoning. According to Hendrickson, the deductive method of reasoning in accounting is the process of starting with objectives and postulates and from these deriving logical principles that provide the basis of practical applications. The process of induction consists of drawing generalized conclusions from detailed observations and measurements. The other important approaches are events approach, value approach and predictive approach. Moving on to deductive and inductive approach. The terms deductive and inductive indicate the type of research methodology or reasoning used in formulating an accounting theory. The deductive approach first establishes the objectives of accounting and then derives the principles and procedures consistent with these objectives. The deductive approach begins with basic accounting objectives or propositions and proceeds to derive by logical means accounting principles that serve as guides and basis for the development of accounting techniques. The deductive approach includes the following steps: determining the objectives of financial reporting, selecting the postulates of accounting, developing a set of definitions, formulating principles of accounting or generalized statements of policy, applying the principles of accounting to specific situations, and last, establishing procedures, methods and rules. In deductive approach, all subsequent steps follow the objectives formulated. An important limitation of the deductive approach is that if any of the postulates and propositions is false, the conclusions may also be wrong. Let us now discuss the inductive approach. The inductive approach to accounting theory examines observations first and accounting practices and then derives principles and procedures from these observations. The approach emphasizes on drawing generalized conclusions and principles of accounting from detailed observations and measurements of financial information of business enterprises. The inductive approach includes the following steps. First, making observations and recording of all observations. Second, analysis and classification of these observations to determine recurring relationships, similarities and dissimilarities. Third, derivation and formulation of generalizations and principles of accounting from the recorded observations that reflect recurring relationships. Fourth, testing of generalizations and principles. Now, moving on to events approach. An event is an occurrence, phenomena or transaction that is assumed to be observable. According to Johnson, an event is a feasible observation of specified characteristic of an action in regard to which a reporter could say, foresaw that and saw it happen myself. Thus, the characteristics of an event may be directly observed and are of economic significance to the user. The events approach in accounting theory implies that the purpose of accounting is to provide information about relevant economic events that might be useful in a variety of possible business models. It is up to the accountant to provide information about the events and leave to the user the task of fitting the events to their business models. It is up to the user to aggregate and assign weights and values to the data generated by the event in conformity with his or her own utility function. The user, rather than the accountant, transforms the event into accounting information suitable to the user's own individual decision model. The greatest limitation of the events approach at the present time will be that the users of accounting information may not be able to use it properly in their decision making. Many users are not able to interpret fully even traditional financial statements. The attempt to measure the relevant characteristics of all crucial events affecting a firm may result in information overload. Besides, the criterion for selecting what information should be presented has not been developed. It is not yet certain that the events approach will lead to better predictions or that measurement of events is more verifiable than measurement of objects. Events approach assumes the existence of many and diverse users, and therefore financial reporting in this approach is not directed towards specific users. It also assumes that the user should be able to select the desired information from a broader list and also to decide the amount of aggregation. A user can generally aggregate accounting data with sufficient detail but cannot disaggregate data without the detail. Now, let us understand the value approach. The value school emphasized that the needs of users are known sufficiently to allow the deduction of an accounting theory that provides optimal input to the specified decision models. However, it is accepted that input values cannot be optimal for all users and users. In the value approach, the balance sheet is regarded as an indicator of the financial position of a business enterprise at a given point in time. On the contrary, in the events approach, the balance sheet is regarded as an indirect communication of all accounting events relevant to the firm since its inception. Similarly, in the value approach, the income statement is perceived as an indicator of financial performance of the business firm for a given period. In the events approach, it is perceived as a direct communication of the operating events occurring during the period. In the value approach, the funds flow statement is perceived as an expression of the changes in working capital. In the events approach, however, it is better perceived as an expression of financial and investment events, in other words, an event's relevance rather than its impact on the working capital determines the reporting of an event in the funds flow statement. Which approach, event approach or value approach, should be followed depends on many factors such as decision models, users' informational requirements, the need to predict specific events, etc. Let us now discuss the predictive approach. The concept statement number 1 of FASB states that the objective of financial reporting should be to provide information that is useful to present and potential investors, creditors and other users in making rational decisions. Similarly, the concept statement number 2 of FASB, of FASB mentions that predictive value is an ingredient of relevance, a primary quality of financial reporting. If accounting data are to be relevant for the making of decisions by investors, they must provide input into the decision models of the investors. And since only expectations of future objects and events are relevant for these decision models, it follows that if accounting data are to be relevant, they must provide or permit predictions of future objects or events. This statement highlights the significance of predictive ability of accounting data in decision making. The predictive approach to the formulation of accounting theory uses the criterion of predictive ability. One of the purposes of collecting accounting data is to facilitate decision making. Predictive ability is a purposive criterion. The AAA Committee on Corporate Financial Reporting suggested 4 ways by which accounting data can be related to the inputs of decision models. First, direct prediction can be made by accountants or by managements in the form of forecast, which may be evaluated by independent accountants. However, managements have been very reluctant to making forecast for fear of their misuse by competitors and others. Second, indirect prediction is the common concept applied to the predictive ability of accounting data. Past data can be used to forecast future objects or events by extrapolation or projection of the past into the future, making necessary adjustments for changes in environment or external factors. Third, the use of lead indicators would emphasize the ability of accounting data to predict turning points. A search is made for data whose movements in the objects or events are being predicted. Example, an increase in debt equity ratio might precede a reduction in cash flows to the firm available for dividends. Fourth, corroborating information may also be used as predictive indicator. The specific accounting data along with other available information may make prediction possible. Many empirical accounting research studies have been made on the basis of the predictive approach. Some refer to the prediction of an economic event, while others are concerned with the ability of accounting data to explain and predict market reactions to disclosure. Let us now recapitulate what we have learned so far. Accounting theory was distilled from accounting practices. As such, the process of theory construction was of the reverse order, that is, making accounting practice the basis of constructing a theoretical framework. The descriptive approach. Theories developed using the descriptive approach are essentially concerned with what accountants do. In developing such explanations, descriptive theories rely on a process of inductive reasoning, which consists of making observations and of drawing generalized conclusions from those observations. Induction. If every hair which we have observed eats grass, by induction we may induce that all hairs eat grass. Deduction. From the general proposition that all hairs eat grass, we may by deduction infer that some hairs eat grass. Events approach. An event is an occurrence, phenomena or transaction that is assumed to be observable. According to Johnson, an event is a feasible observation of specified characteristic of an action in regard to which a reporter could say, foresaw that and saw it happen myself. The value school emphasized that the needs of users are known sufficiently to allow the deduction of an accounting theory that provides optimal input to the specified decision models. Thank you.